Okay. So, welcome everyone to another episode of our knowledge-based podcast series. This time we have with us Mr. Ekansh Mittal. Ekansh sir is the founder of Katalyst Wealth. Katalyst is probably one of the oldest research firms providing equity research for retail investors in India. Welcome, Ekansh sir.
Thank you, Ankush. Thanks a lot for having me on your podcast. Look forward to some engaging conversation.
Right. Before going ahead, a quick disclaimer. So, Search Capital is a trade name, brand name used by me, Ankush Agrawal. I'm a SEBI registered individual research analyst. Nothing that we discuss in this podcast should be construed as a recommendation. This is purely for knowledge sharing purpose. Answer if you can put your disclosures.
Yeah, so Catalyst Wealth is a brand name that we use. I'm again an individual research analyst with the name Ekansh Mittal, proprietor Mittal Consulting. And whatever we are going to discuss is only for the education purpose, nothing as an investment advice or a recommendation. So don't consume anything as an investment advice, and the investments in markets are subject to market risk. So please read all the documents carefully.
So, Answer, let's start from the beginning. Like you have been in the markets for probably more than almost now 2 decades now. So, if you can talk about how you started in the market, what was your initial journey like, what led you to start Catalyst, and how has that journey been? Because Catalyst itself would now be almost 15 years old. If you can talk about your journey in the market.
So yeah, like I think I've talked about it quite a few times. So I was born in a family where like the stock market discussion was always happening on dinner table. So my father was actually a member of UP Stock Exchange. He was a broker,
Okay.
and we used to have those annual reports in our house. I mean, he was basically a long-term investor. He had invested in a few companies, and then we also had Economic Times at our home. Like it was a regular newspaper that used to come. So I had an exposure to markets from an early age. And luckily, my father was also quite like encouraging in that way. He used to tell me to like simply look at the Economic Times, and he used to just guide me when I was like pretty young, that maybe you could look at the list of stocks with high ROC and low P. I think at that point of time, they used to give that list. So that way, my exposure to the market was quite early. And I also realized that, I mean, there were certain stocks, I think some pharma stocks, probably Cipla, Aurobindo, and Dr. Reddy's, and all that had like multiplied quite substantially. So, and he had been holding them for like several years. So that way I realized it probably got into my mind that it is a good vehicle for like creating wealth. And long-term investment, again, like we never used to talk so much about like daily trading or anything of that sort. It was always used to be about like investing. So that way I got into long-term investing and long-term wealth creation. And at the same time, I also got an experience as to how markets can be very risky as well. Because my father, although he had a good portfolio, but I think he also kind of pledged his shares for certain business loans and all. And I think that was probably when the Vajpayee government conducted those nuclear tests, and the US government imposed
Correction.
the sanctions and all. So I think the market kind of crashed that time, and the stocks crashed, and he lost a lot of wealth. But I mean, a substantial amount of shares got sold that way. So yeah, so I also realized that, I mean, there are risks to it as well if you are pledged or if you are leveraged. So also that kind of experience kind of came in early. And in fact, we saw a bad time that way, but I was always inclined. And I think when I had joined BTech in 2006, my first year, somehow I did not enjoy the BTech part much. And I started like reading too much and trying to I mean, I was always in the library reading Economic Times. So I was trying to like accustom myself about the stock market and reading about it. And I think towards 2008, towards the end of 2008, when we had a great global financial crisis.
Right.
So I think that's when I opened my Demat account with India Infoline in November 2008.
Okay. Okay. So 2008 end is when you started trading on investing on your own.
Yeah, so I used to get some money, like
Okay.
anyone who's like staying outside, so he gets some money. So I was saving. I mean, probably I started with an investment of 2K, 5K, probably, whatever smaller amount I had, and I had gone to open a bank account and even told someone that I'm opening my Demat account. So, so I remember that month very vividly, November 2008. I think that's when we also had this Mumbai 26/11 attack,
Yeah.
I think.
Yeah.
So a lot of memories of that month because my parents' 25th anniversary, Mumbai attack, and I opened my Demat account. So I started with 2K, 5K investment that month.
Okay.
That's how I started on my own.
Right. So 2008 till 2011. 11 is when you started Catalyst. So what was that period like? Do you were investing on your own or you did something in the markets?
Yeah, so I kept on investing. Luckily, by the mid of 2009, I had also started writing blogs and freelancing.
Okay.
So I was getting some money. In fact, I was getting a decent money in those days by those standards. Towards the end of 2010, when my BTech ended, I was getting almost like 18, 19K per month earning
Hmm.
that way, which is what I was also offered as a part of placement at Infosys, which I did not take up. So it was similar.
Alright.
And so I was investing that money and also worked for a year. And then in 2011, I think around July, June, I started this Catalyst Wealth because the idea was, uh, so I was also already like researching on stocks for the past 3 years, mostly
Right.
small caps and mostly small caps, I would say. And the idea was that if I have to grow my wealth, I need capital. So how do I
Right.
get that? I did not know how to trade in markets and how to generate capital that way. So I started this research outfit. And the idea was that I would like to serve it to the clients, whatever I'm researching for myself. Whatever I find good for myself, I'm going to offer it to clients. So that's
Right.
how 2011, the Catalyst Wealth was started.
Got it. Got it. So what was this initial period like? Were you investing probably primarily based on, whatever you would have grasped seeing your father invest, or so a lot of people now starts reading say XYZ book and that forms the base of how they want to invest, and obviously they learn over time. But for you, how did that initial experience was like? Like how were you investing in those days? Like
So when I initially started in 2008, I mean, what all, see, I'm from a science background. I did not have an accounting background or commerce. So you read some books like Intelligent Investor, Peter Lynch, right? And the
right,
few metrics that you know is growth and PE, price earnings
right,
ratio, because those are easiest to know, right? You don't know how to do detailed analysis or balance sheet or very fine qualitative analysis. So initially, when I started, I invested in a few stocks. Anyways, if you had invested in 2008 global financial
yeah,
crisis,
yeah,
any stock you would have picked would have done well at least for the next 1 or 2 years. And that's how eventually, and also a lot of buzzwords as well, like, okay, biotech at that point of time, there was some biotech stock or some niche technology. I mean, some company was offering some technology to ensure that your car doesn't get, I mean, the thieves are not able to take away your car. So
mm,
those were, I mean, and then you were looking at the numbers, at least the P&L numbers, because even I did not have much knowledge about how to analyze cash flows back in 2008, 9. So you start that way and you look at growth and PE and I started investing. Luckily, as I said, because the markets were deep down in 2008, so those stocks did well. But if I check them now, probably they are not listed. So those were
okay,
not good companies that way, qualitatively. But you made money as luck was that. Then I was also like, "Ki I'll only pick very micro cap, penny kind of stocks initially because those are the growth stocks where that's where the highest potential for growth is. But again, you kind of make a lot of mistakes. And after 2010, I think the market peaked out in November 2010. Then there
right,
was a very bad period for that, and the market started crashing and the
yeah,
stock. So so you realize that okay, you are making mistakes. It's not just about PE and growth only. You have to also look for qualitatively. I think the
right,
one stock probably in 2010 or 2011 that changed my perspective of investing and qualitative was Sera.
yeah,
So I somehow landed that stock and probably I think since you could see that brand, at least I had some visuals in my mind about looking at that brand probably in some washroom, probably some place because either Hindware, Sera, Jaguar, on the wash basis, you could see the brand. And then when I
right,
used to roam around, I think when you roam around those malls during those times. So I think Bangalore Central had like a huge mall, and their top floor had a washroom section. So I
Right.
always kind of thought, okay, that these are good products, and if probably sometime I have good money, I'll like redo my washroom in such a way that
Hmm.
so, and then when I looked at the numbers, the consistent growth, 20 odd percent, I think at that point of time, 8 times earnings, not much debt. Because earlier, even if the company had very high debt, I would still have bought the stock. But
Hmm.
like I
Right.
was now cognizant of that, okay, debt also matters you that way. So like not much debt, promoter increasing stake. So
Right.
that's where I think the kind of qualitative thing
Right. Right.
changed.
Yeah. That's true. Actually, the first investment that works very well, and it. I mean, a lot of investors start from a data-oriented approach. It happened with me also when I started. I started with a very data-oriented approach. I thought that being a CI, I can read financials very well, and that's how
Yeah.
I'll figure it out. But eventually, I realized with one stock for me, that stock was Suven Pharma back in 2018. You know,
Okay.
this is the kind of businesses that are there in India. Like earlier, I used to read a lot of normal traditional manufacturing B2B kind of business, but looking at Suven, you realize, this kind of high innovation work kind of business is also available in India. And that is where, you can put some qualitative understanding of the business, and that is where the true game is. So, Ekansh, with Sarah, uh, obviously that shaped a lot of initial investing for you. So did that become a base for you to kept looking for company like Sarah to eventually in your investing? Because I know that you made a lot of money in Amara Raja as well, in Kaveri Seeds as well, and similar kind
No,
of companies.
Kaveri Seed we invested recently in 21, so not then, but and luckily it's doing well now.
Yeah.
But at that point, yeah, definitely the success of Sarah and being able to like look at a brand. So at that point of time, and luckily at that point of time, these consumer brands were trading at relatively low valuations.
Yes, obviously.
So like 8, 10 times or 15 times earnings, they were growing quite well. So yeah, so I think at that point of time, I invested in a lot of stocks similar, or at least where there I could see a brand. Somaraja, we invested in that. We invested in Symphony. We invested in Supreme Industries. In fact,
Right.
one brand I did not invest in was Astral. Although those were the days of value picker and a lot of discussion was happening, a lot of analysis. Somehow I kind of inclined towards Sarah ki nahi, ye to dikhta hai. I mean, I could
Hmm.
see the pipes
Okay.
I cannot see, but obviously I missed out on Astral that way. But yeah, where I could look at the brand and see the earnings and the qualitatively balance sheet. At the same time, I think around that time, Professor Bakshi had written a note on Hawkins cookers,
Hmm.
and
Right.
that was like a such a great note. I mean, if someone had to do how to do understand how to do the qualitative analysis, that became the benchmark, the note on Hawkins and Nespo and on. So that kind of shaped my investing at least for the next few years, and it did quite well because
Right.
2011 to 13 was a bad period for the market, but because we had those stocks and those were doing well, so we did well.
Right. So, Ikansar, now, like after almost 15 years since that time, if you were to explain to someone like how you invest, like some of the key aspects of what your investing framework is about.
If I have to put it very simply, I mean, it's mostly about growth at reasonable valuations.
Okay.
That's a simple way to put it, but there are a lot of nuances to it as well. So, like I gave an example of Sarah, so that was growth at reasonable valuations then, because like 20
Right.
odd percent CAGR, 18 times earnings or 15 times earnings, so growth at reasonable valuations. But then, as these brands became famous and even the markets realized the qualitative aspect of these companies, now normally you don't get these kind of companies at such reasonable valuations. A lot of times they are already trading
Right.
at 40, 50, 60 times earnings,
Right.
right? And even the growth aspect is not that significant. If it is significant, then those might be trading at 80, 100 times earnings. So I'm
Right.
unable to buy, probably has some anchoring bias, I'm unable to buy those kind of stocks. But then the other nuances to it would be that there could be a good company going through a bad phase, right? I mean, the bad phase could be in the form of they may have done a major capex recently and it's taking time for it to scale up, or because they might be growing, but there might have been some changes in the raw material or product mix or whatever, due to which the margins have collapsed or kind of corrected from from whatever they have been doing in the past.
Right.
So, or say cyclical companies, commodity companies, you have metal, sugar, and cement kind of stocks. These are, I wouldn't say, so they have their own growth cycle and down cycle. So if you could probably pick them up during their down cycle, when you think the down cycle has happened, or maybe towards the end of down cycle, then they would again have a growth cycle. And you
Right.
could buy them at reasonable valuations during their down cycle. Obviously, not on the metrics like price to earning, because during the down cycle, their earnings might not be there at all or
Right.
very minuscule, but on other metrics, probably replacement cost or price to book, so other ways. So the ultimate idea is that if I could find some opportunity which could have a good runway for growth, probably for the next 3 4 years, and if for some reason I could find them at reasonable valuations because probably the market is not valuing them right because they might be in the down cycle, or they might be
Right.
having some other temporary issues which I believe they things could be rectified. So those, and again during like 2019 kind of a market, you could get good growth companies again at reasonable valuations because the overall market is down.
Right.
So that's how you, I mean, the different aspects or the nuances to the growth at reasonable valuations is what I look at.
Right. So broadly, correct me if I'm not getting it right. So over last 15 years, like what you've obviously very well put that the discovery of growth has become relatively easy, which is why the companies are bid up to a certain price and it becomes difficult to buy them. So over the last 15 years, the change that you have done is you have stuck to your understanding of valuation. That's a factor they have hold on to. But you have tried to figure out uh, different opportunities wherein growth can come. Right now, the cheap valuation is an outcome of near-term issues and not discovery. Wherein in the early stages, the cheap valuation would be an outcome of the company not being well discovered. But now those opportunities would be there. Either it could be an outcome of very difficult market or stock specific issues.
Yeah, so exactly. So I think earlier, for whatever reason, I think there were also times when the markets were well discovered, but you could still get them at like some reasonable valuations. And but now, as you have seen, at least in the last 4 5 years, like 80, 100 times earnings or 50 plus
Right,
100, 50 plus times earnings have become quite common. Even for a very simple brand, I mean, it could be a company selling chappals or paints, as we have seen,
right,
but they got traded up to like 80, 100 times earnings, and I could not buy them. But then you could have different, as you said, like you could find companies where growth may not be there right now, but either due to some change in product mix, or maybe say deleveraging of balance sheet, or just the mean reversion in terms of like cyclicality of the company. So that's where if I could buy them, and for the next 3 4 years or 2 3 years, that's how I try and look at that. I have to look at for the next 2 3 years growth or 4 years growth, and if I could buy
right,
them at reasonable valuations.
right. Right. So, Ekansh sir, in this kind of portfolio or screening that you do, what according to is the one of the major reasons wherein you can find these opportunities? Like, okay, heavy capex and during scale up phase, obviously higher debt and depreciation is a factor that people know. What other situations lead to this kind of opportunities? Like some of the two, three, wherein you find the most opportunities for yourself.
So the screens that I have created, largely 2 or 3 screens. One is capex oriented, as I said, wherein
Okay,
I'm looking at normally what I do is like I'm looking also for growth. So I put in
right,
say like 5 year sales CAGR 7% plus. So I'm not really
okay,
looking at 15% plus at one go because I want my universe to be broader, wherein I
right,
could like work on companies, research on companies. Because if you just simply put 15% plus CAGR, that
right.
the universe of stocks that you would get on screen would be very low and you won't have
Yeah,
much to research on. I would simply put in 7 8% CAGR. So what I'm trying to do is, okay, there are companies which have been growing, not maybe at fast, but yeah, they are
yeah,
growing. Then secondly, a lot of times I would put on my screen operating margin for the last year less than 5 years operating margin.
okay,
So the idea I'm trying to look at is, okay, the company is growing its sale. Maybe its average operating margin for the last 10 years was 5 year about 10%, but last year was 7% or 8%.
right,
So the margin collapse is what I'm kind of looking at. Right. So this way, what happens is a lot of times, and then I don't know what kind of company I would come across. It could be a
Right.
cyclical company, uh, because it might be going through a down cycle. That's why its margins are down, although it's growing its sales because of volume increase or whatever, or price increase. Or it could be a normal company, might be going through a very temporary bad phase. That's what we have to determine at the end of the day, if it's a permanent
Right.
issue with the company or temporary. So normally, if I'm running this kind of a screen, either with capex, large capex, so the capex I'm normally looking at is कि 3 years में वो the fixed asset would have been say 150% of the 3 year back fixed asset, or the
Right.
capital work in progress plus the fixed asset is say 150% of what it was 3 year back. So I'll just give you an example again for education purpose.
Yeah.
So there was this company, I think Greenply in 2019, and they were
Yeah.
demerging their MDF business,
Yeah.
Green Panel. And 2019, they had done a major capex, like 5,40,000 cubic meter kind of expansion for, and almost taken like an European line and 600, 700 crore debt. But that was it, that they had set up the line, they had taken the debt. And the issue at that point of time was that a lot of other players had also set up capacity, because in the previous cycle, there was a good demand for.
Right.
So since companies like probably Century Ply or Action Tesa, they had also set up, so the utilization was low. But then if you had looked at the company, the margins were low, they had reached peak debt, and since they were not going to, and the industry demand was also growing at around 15-20%. But since there was debt and high depreciation cost, the stock was down. So one could have
Right.
looked at that kind of company
Yeah.
during that period.
Right.
So that's how normally, like, and similarly, we have had cases like, I mean, Chamanlal Sethi Exports, and it's a cyclical company in the sense that its margins tend to range between 8 to 12%. So normally we are looking again at that company when margins go down, even though
Right.
they have been growing their sales year on year.
Right.
So those are the cases that we look at, because what happens is that if you're probably just, for example, buying at 8% margin, and the earnings might be down a bit, so the valuations also go down, the stock price is
Yeah.
down. But assuming the cycle turns around, the company is growing its sales continuously, and the margins go back to 12%, the market is in good mood, and it's
Right.
it gives you higher like valuation in terms of price to book or earning. So you're getting a combination of factors like margin expansion, sales expansion, and PE or
Yeah.
price to book re-rating. So if you're getting these three, four combinations, you could get a 4, 5, 10x on stock in a good market.
Right. Right. Yeah. I mean, you had highlighted this framework of mean reversion plus growth, and in one of your tweets, I think last year, where you said that once you get mean reversion, it's one thing, but if you get growth on top of that, the discounting is like huge, because suddenly the
Yeah.
company goes from neglected company to company wherein everyone is interested. One thing over here, Ekansh sir. So, okay, cyclical now is a big part of your portfolio, because therein you can find a lot of these opportunities that you're looking at, right? And the second part is,
I wouldn't say cyclical big part of portfolio, because it's a part of portfolio, maybe 10, 15, 20%. It's also
okay,
like there are different kinds of companies as well. Like you would still get something like some time back we invested in Time Technoplast, for instance. So there was a change in product mix, and they were trying to do something around their like balance sheet, like working capital and all, because
all
their
right,
working capital cycle was high. So they were trying to change the product mix, wherein the value added products uh, were getting higher as percentage of the overall sales. So there are also these kind of companies wherein the perception can also change, because once the
okay,
product mix change, you could have like a change in overall operating margin of the company, and at the same time the company is also attacking its balance sheet by trying to bring down the working capital. So these are not
right,
exactly very cyclical. It's also about like uh, the smaller changes that might be happening at either the balance sheet level or the product mix changes, which could also give you good opportunities, because the market may not be giving you good valuations currently, but if the product mix changes or the balance sheet improves, suddenly the market could start giving you higher valuations for these kind of stuff.
all right. So, Ekansh sir, in this kind of opportunities, how do you go about buying an allocation? Like, is it that you, once you believe that, based on your understanding, this is the worst thing or the worst result that will be there? Like, there's a normal saying that you should, the stocks bottom at the worst time, right? The worst result it might report, maybe probably that's the time the stock will bottom. So, how do you go about buying? Like, do you buy once you see some signs of recovery, or you start preemptively buying in anticipation of that recovery will happen, or how is it like?
So it could vary for different cases. Like if it's a highly cyclical company it's in a downward phase, wherein I'm not exactly sure when exactly the cycle will turn around, but on other metrics like price to book, it's looking very cheap. So I could start buying, may not build up the entire position in one go. But for other companies wherein I'm already seeing some certain changes, the market may not be giving high valuation, but I am also finding the valuations to be reasonable. And I
Okay,
believe that because the product mix will change and the balance sheet will get a lot better, so so the earnings could improve substantially. So in that cases, I like to buy 3 to 4% of my portfolio in one go.
okay,
And eventually, like if things are turning out well, and if the execution is well, I may keep on adding depending on the cash flow as well on, at my level. So if there's a good cash flow, I could keep on deploying, and if I'm finding the valuations reasonable. But yeah, in other cases wherein, for instance, we are also looking at certain like potential turnaround opportunities based on promoters' actions. That's
okay,
what like we have been like wherein the industry might be down, the stock might be down, say 50, 60% from the high, and suddenly we see that promoter is infusing capital largely to himself,
okay,
not
okay,
to non-promoters, or
okay,
even if to non-promoters, a very small portion. So in those cases, we may do some buying preemptively
okay,
because promoter is buying and the stock looks down and we see that there is potential for turnaround. So we, even though the turnaround may not have actually happened, so we may buy
mm,
preemptively and probably a smaller allocation, say 2%, and see if
got it,
things turn around. So it
got
depends
it.
on case to case, but yeah, that's the normal range that I look at, like 2 to 4% allocation in one go for a
Okay.
stock.
Yeah, that's what I'm trying to understand. So the insight that you gave is that if the promoter is buying heavily, then obviously there's something near term or something is about to change. So you might preemptively buy with that. Makes sense.
Yeah.
Makes sense. Then say, Ekan sir, say for example, you do take such kind of bet, the thesis plays out perfectly, from a down cycle, things have mean reverted to a certain level. Obviously, it will again vary case by case, but are you one of those investors wherein, when things have returned to normal, you sell for the most part, or do you want to ride the sort of FOMO or growth part wherein the stock goes into momentum, obviously, there's some companies wherein they will mean the word and they'll keep executing more than what you have been thinking, right? So in those cases, like, do you hold on to for that last leg, or for the most part you are out once a certain kind of turnaround has happened or mean reversion has happened?
I like to mostly hold around. I mean, it's
Okay,
not, as I said, the idea is mean reversion plus growth. So the when the company is
right,
mean reverting itself, that's also some growth, right? Because you're
right,
coming from down to mean
right,
itself, so that's some growth. But then I'm also looking for growth beyond that because normally, I mean, when there are tailwinds and when the execution is well, a lot of times the growth keeps happening at least for the next say 1 or 2 years or so. So I'm not like
right,
mostly out. And then see, selling obviously is a very difficult thing in comparison to buying. So
right,
I'm trying to incorporate a few things. I also try and look at the chart patterns. I'm not an expert on that. Then we're also looking at data like number of shareholders because you kind of get some details about that. And then obviously because what happens a lot of times the stock may have peaked much earlier than the
mm,
company performance.
right.
And
Yeah, that's true.
I've seen that in a lot of cases. In fact,
Yeah,
uh,
yeah,
and when I saw that, so as a fundamental investor, you would think that this company's sales are still growing, but the stock is still like down 50% from the high. Ideally, it should be like
right,
near the top. When
right,
so I'm also looking at other alternative data, like I mean the number of shareholders, and to kind of improve my selling of stock. But to your question, it's not just about mean reversion that mean reverts and I kind of sell. I'm willing to hold it for growth, and obviously it depends on the guidance from the management and our own analysis understanding. But normally
right,
the pendulum swing is like from one extreme to other extreme. It's not just about
yes,
me. So I'm hoping that for my investee companies, at least, it goes to the other extreme.
right, right. Got it. One question that I really wanted to ask you, Ekansh, is that being so long in the markets, what according to you have been some of the biggest changes that has happened in terms of generating alpha in our market, especially on the small and mid cap side? Obviously, one thing that has been clear with multiple discussions, even with discussion with you, is that the discovery was relatively easy. The valuation probably structurally was lower. Now, obviously, in certain situations they are lower. What else, according to you, have been some of the major changes that has happened that has impacted how you invest?
So I think discoverability is definitely like we have great tools, Screener, Tejori, and the information flow is like, I mean, you have Twitter, you have WhatsApp
Right,
groups. So the information flow is very fast these days. And if you have a good market at the same time, like we had from 2020 to 24,
right,
then uh, the news comes to you and you don't even get much time, especially for such kind of growth companies, wherein you could spend some time, research, build some conviction, and take a bet. So I
right,
think that has sped up, uh, at least in the last few years, uh, with these tools and the social media. So I think that's where I'm trying to kind of change my, because I'm a bit valuation conscious. I'm unable to buy like high growth companies at very high valuations. That's not,
right,
I could do that maybe with certain like stop losses kind of a way where you're trying to ride the momentum, but then you won't be able to take a big bet. At least I'm not able to do that. I may change that later on, but right now it's not the
right,
situation. So I try and take a step back, as I said. So maybe I'm looking at those kind of companies where the market is not trying to look at. And they may not be doing well right now, but they could do well, say 2 year, 3 year, 4 year hence. Uh,
right,
so it has actually happened with a lot of companies. For example, we invested in Kaveri Seed in 21, and I think for the last 2 3 years the stock didn't do much, but
right,
at least now it has. I don't know how it will sustain or whatnot, and invested in that stock. But there were subtle changes in the product mix, like from predominantly cotton
yeah,
to
got it.
other
Yeah,
seeds and all. So basically, trying to maintain the cycle wherein I'm probably invested in those companies say 2 3 years back, which might be doing well now, or may
right,
have had a consolidation. So if you take a step back and look at spaces wherein the other shareholders or other investors are not trying to look at, those spaces you could get much more time to research, form your conviction, and also build a position, because they
right,
could remain in a consolidation stage for a say 1 year, 2 year period, and that
right,
could be frustrating for a lot of investors per se.
yes,
It is obviously for me as well, but then it also allows you to build your positions. And then there are
right,
obviously certain other stocks in your portfolio which might be doing well right now. So
right,
you cannot have all the stocks performing at the same time. And but yeah, I think to your question again, the discoverability part has changed quite a lot that way, and that's where I'm trying to change my investing, wherein I'm trying to take a step back and looking at those companies where the others might not be looking at.
right, right. So here in this case of like Kaveri that you were explaining, that you waited for almost 2.5, 3 years before actually seeing that. So uh, is there sort of, because obviously there would have been times wherein you would have invested, things would have been playing on, but the stock eventually never did anything, right? Uh, so over the years, based on this experience, have you made any changes wherein, say there's a time stop? Okay, if the company continues to execute, because Kaveri had been changing its mix of bus cotton for very long. I think from 2015 when it stopped, from there the mix changes happen and it's continuing to happen. So if the company keeps doing what you are expecting to do, will you be able to hold for like 4 5 years also, or there is a time stop where after a while it just becomes frustrating that you don't want to hold or you want to rotate capital? Has that happened, and are there any rules that you have made? Okay, 3 years we'll wait. If it doesn't work out, then we'll exit, or how is it?
So frankly, I haven't made that rule, and there have been cases where I've held on to stock for long, and that didn't do for
Right,
quite a substantial period. So, for example, like I mean, Manapuram, we invested in 2017. Right now, maybe things might change with the new co-promoter coming in, but I
right,
don't know. Like I mean, the returns haven't been great, and
right,
just that the valuations looked good, and I thought, okay, uh, there's a good growth potential, but every like second year, there would be some other issue that would come up.
Yeah.
But just that the valuations looked attractive, I could not sell. And I'm frankly a bad seller that way. I have held on to stocks for like 4 years wherein there have been no returns. And because I think that probably the time I'll sell, the stock would go up, something would
Yeah.
change. And it might have happened. It might have happened. So, like, till the time I'm finding valuations right and thinking that, okay, on the execution part, the management is doing the right things, I'm willing to give a longer rope. And it
Okay.
could become frustrating that way, has happened. But I don't keep a time stop loss that way. That, okay, 3 years, I would sell just because.
Okay.
And
Makes
sometimes
sense.
looking at chart patterns helps because
Okay.
you know that the stock might be consolidating or it might be breaking out after a long range. So that may add help a bit.
Okay. That might provide a sense of comfort that, things are not going bad.
Comfort, or you could take some kind of decisions on the basis of that.
All right. So,
Again, not very perfect because I
yeah,
mean
obviously.
I'm not like haven't automated things at my end in that way.
Right.
And if I'm taking my own decisions, obviously your biases creep in, right?
Right.
Because you have held, as I said, my bias is that as soon as I sell the stock would go up. So
Right.
so I have given long rope to certain stocks. Like for instance, Carousel, probably from 2014 or 15 to 2020, zero returns.
Yeah. And then obviously
Then
substantial return.
10x kind of
10x.
like, so yeah.
All right. Right. Makes sense. So in this period of consolidation, how do you look at allocation? Do you buy at opportunities time, or do you wait for that price action to show you that, okay, this is the time it is making money, or
So
like you
if
do
I have
you
like
keep adding?
if I have already like invested whatever allocation like 3-4%, then
Right.
I like don't
Let
keep
it
on
be.
adding. If I'm seeing
Okay.
consolidation and no major price action, tight consolidation, I may not add. It might happen that one day that the stock may seem like breaking out.
Right.
Then I may add
Okay.
because just keep buying through consolidation also becomes frustrating at some point of
Right.
time, and you don't want to
Right.
frustrate yourself by keep on adding capital. So I kind of wait
Right.
that way if I've already made my allocation to a stock, which is like three four
Okay.
percent.
Okay. So 3-4% is the basic like standard that you allocate for the most part.
So my idea is that with 25 what kind of stocks you could build a good diversified portfolio. It
Right.
also opens up optionality because I don't want to run a very like concentrated portfolio. Uh, uh, because you would end up
Obviously.
missing out
Yeah.
a lot of opportunities. And frankly, I wouldn't say that my research is so deep so as to say that I'll only buy 5-7 stocks. It would require like great amount of research, being constantly on top of stock, being constantly probably in touch with the management that way or whatever. So I
Right.
cannot do that, and I don't have that kind of conviction. So I think with 20-25 stocks, you open up optionality as well, and you're also kind of keeping it
Right.
good, reasonably diversified and concentrated.
Yeah. Makes sense. I mean, in your style of framework wherein you might have to sit through consolidation for multiple stock, I think a wider net helps.
Yes, yeah. That way also,
But
because there might be certain stocks, say 5 stocks, which might just be consolidating
yeah,
that.
yeah, yeah, makes sense. Makes sense. So Ikan sir, since you have been in the market for so long, like you have seen obviously 2011, 2015 sort of, say 2013 sort of bear market, then obviously 18, 20 was another phase. Now also we are starting to see a difficult phase. So, what, according to you, would be some of the do's and don'ts that investors should do in this kind of, market correction?
Yeah, I think the general do start with, irrespective of whether it's a bear market or bull market, even we tell it to our clients. I mean, no matter what, whether it's a bull market, bear market, you don't know because things change overnight. Don't invest that money which you think you would require in the next 4-5 years.
Right.
I mean, you because that is what is the most frustrating part. You invest right now, it might be a bull market, and then suddenly next 2 years bear market, and you have lost 3 years and no money, or the returns are down. So ideally, anyone who is investing in stock market, he should only invest that money like which is there. And then I mean, if if you started in bull market, because a lot of people
Yeah,
unfortunately start towards
towards
the
the back
fag
end.
end of bull market
Yeah,
or whatever. And then suddenly you see like a 20% correction that we have seen.
Right.
Then probably it's time to like wait and maybe change your portfolio, reshuffle your portfolio. But now if you are like looking to exit, you're probably making two mistakes. Like first you made a mistake when you entered towards the fag end of the bull market, and then the another mistake that you are doing is like exiting probably at the wrong time.
Wrong time.
So initially, I think you have to like mentally uh, adjust yourself in the sense that you have to remain invested for 4 5 years. That's how the markets have been. Like probably they peaked out in 2001, but if someone had remained invested say till 2005, he would have still made money. Probably 2008 to 13 was bad in that sense, because if someone had invested in 2007 8, then
Yeah.
even though we had a good recovery from 2009 till 2010, but then
Right.
2010 to 13 was
Bad.
bad for small caps. I mean, the
Right.
valuations. Obviously, there were certain pockets. We were lucky that way. As I said, we got into those consumer pockets and got lucky. But otherwise, the markets are bad. So I mean, these market, for instance, like 2018 to 20 was a bad market, and I keep still thinking about that, because I mean, you have a strong grinding period, like, and
Yeah.
the prices are down 40% odd. But then it's the nature of the beast. We have had good runs like for 5 years of good run. Then you have to like understand the fact that there will be bad periods. And in fact, I put up recently posted 10 truths about bear market, and this was based on S&P 500 data. So the average duration of bull markets is always greater than has always been greater than the average duration of bear
Bear
markets
market.
in general.
Yeah.
So I think one could always take those facts into account and like mentally prepare oneself that okay, this is a bad period. We have to just live through it, like
Right.
for the 1.5 2 years, and then eventually things will turn around.
Got it. Got it. So Ekansh sir, one thing, if you can talk about some of your biggest winners and also some of your biggest losers, don't necessarily have to name those companies, just a broad uh, thesis, how it worked out, why it didn't work out, and what were some of the key learnings that you get out of them.
So I think like the winners have been across different like time periods. Like as I said, in 2011 there were stocks like Sera was a good.
Some of the key winners that made you learn something. Obviously, not the biggest winners, but something wherein you learned something that came out of it. Like,
So at least for me, the two things matter a lot: valuation and growth. I mean,
right,
valuations are important, and you realize the importance of valuations only during the bear market.
right,
So when things are
true,
going well, stocks are doing well, you're putting in any kind of money at any kind of valuations, and you realize, okay, but suddenly what you see is that, okay, 80p stock is down to 40p or 50p, and the stock is down 50%, and you're still not finding value in that, or you're still not getting conviction to buy that. That's
right,
when it hurts you that, okay, you made the wrong decision.
right,
So at least when I'm trying to buy a stock, uh, there could be obviously changes at a later date, because there might be certain changes in the business or something which may change my mind about whether to buy the stock or not. But I would be extremely like discomfortable if I bought a stock at a certain valuation and everything is fine, and even after correction I think, okay, no, whether this 40p could become 20p or 30p. So I don't want that
okay,
kind of. So that's where I think the learning has been for me, that if to survive in the market for longer periods, valuations matter a lot.
right, right.
That's at least core to my investment philosophy.
So, any specific case study that made you realize this?
Hmm. I'll have to think about that, because I probably never bought like very expensive stocks that way. But if you see, for instance,
Like, there would have been losers. Like, last 15 years, there would have been cases
yeah,
wherein you
there have been
lost
multiple
money.
losers. There have been multiple
Yeah,
losers, and I think probably I was like expecting some kind of growth, which did not happen. Or recently we invested in a chemical company. Right now it's down around 30 odd percent, 40 odd percent, because I was expecting a turnaround in the cycle, but it's not happening. But so
right,
there have been losers. The losers have more been around the business cycle part of it, more than the valuations,
okay,
I would say. wherein I was expecting either the growth to continue or the cycle to turn around, and that did not happen.
Correct. So
Not
basically, losers have been normal outcome of batting average. Like obviously, 10 bets you made, couple of them sprint made out,
Yeah,
straightforward.
so that's been the batting average, and I think that probably won't change for me. So I think if
Okay.
I'm investing in 10 stocks, I'm pretty sure that three, four would go wrong, three odd would go
Correct.
wrong.
Correct.
And so that's how, I mean, obviously, when it's a bull market, and if you look at the portfolio at that point of time, probably every stock will be in gain.
Right.
So that's not how I see it. But overall, over longer term, if I have to see it, probably like three stocks would go wrong. And mostly the mistakes happen around the business part of it, the business cycle part of it. You might be expecting the growth to continue, either due to the doing some part of the management or the business, or on the macro level itself, there is some slowdown, because of
Right.
which the growth did not happen and the stock did not perform well.
Makes sense. Makes sense. Okay. So the last thing, Ekansh sir, with each of this podcast, what we want is the two key takeaways for every listener towards the end of it. The first being like one piece of advice uh, that you think is very important in the sense that that could have material difference in investors investing outcome, maybe something that you might have shared to you 10 11 10 15 years back, and secondly one area or one business that is looking interesting to you at the current state. Don't necessarily have to name the company, but even directional insights of what the company does or the sector does can help.
I think regarding important thing, if you are investing, frankly, I mean, everyone is looking at the rate of compounding
Right.
generally. I think the most important part of the equation of compounding is T,
Yeah, I mean the market.
because principal then 1 plus R by 100 to the power T. So I think if you can start investing very early, very smaller amounts. Luckily, I could do that, say around 20 odd years of age. So that allows you a lot of, that gives you a lot of leverage, in the sense that you start with smaller amounts, you could make mistakes, you could learn, and then you have a long period over which you could compound your money. So I
Right.
think obviously not everyone is lucky, in the sense that you would have an exposure to stock market and there would be talks about stock market. But I think timing is important in that sense, that if you could start early. And another important thing is never let go of a good bear market.
Okay.
1819 was a good bear market. I don't even consider 20 that way, because 20 was a 1 month
Yeah.
drop. It was something like came out of the blue. But I think prior to that, we already had a major
Yeah.
bear market
Mhm.
in
Yeah.
2019. And the valuations were like very cheap. You could be buying stocks at 0.4, 0.3 times book value, 8 times earnings. So even though it is tough, and it may seem like, okay, things are not working out well, you would buy a stock which would look very cheap and that would still fall again, right? But never miss a chance to invest in a bear market, and because eventually 3 4 years down the line you would be sitting on loads of money.
Right.
So it's tough, but you have to psychologically deal with that. So I think starting early and like not missing out on is important. Regarding sectors, I think recently it's a very small sector, but it's looking interesting that way. At least a few companies, poultry sector is what I'm liking. I mean,
Okay.
normally, like it's again very cyclical. There are only few listed companies, and then the major components are what is the bird price which it gets sold at, and what is the feed
Right.
price. So the maize is one of the major constituents, the raw material for them, and that's been substantially higher for the last 2 3 years, because a lot of maize was getting diverted for ethanol, and I
Right.
mean,
Right.
right.
Yeah.
But now recently the government has come out with they have released the FCI rice for ethanol companies at lower price. So if I mean the sector has been down, the earnings had been a bit down, the stocks are a bit down, the valuations are reasonable. And if things could turn around in terms of, say, suddenly there might be a sharp demand increase for poultry, or there is a contraction in prices of maize. So you could again have a good up
Right.
cycle of say 2 years or so. So
Okay.
that way,
2021 will happen there.
yeah, it happened around 21. I think a lot
21.
of for a lot of industries, 21 22 was a good period. I mean,
Okay.
pharma, chemical, and all. So right now it looks interesting that way, because if at all the maize
Mm,
prices go down, it could be a good thing for the sector as a
got
whole.
it, got it, got it, got it. So that was a great discussion, Ekansh sir. A lot of learning. I think the last piece of advice that you shared, it's immense. I think that never let go for bear market. I think there's a great wisdom. Honestly, a lot of people don't realize it. Only when the market recovers, they realize, okay, the kind of opportunity that was sitting out there for people to see. I think that was an incredible piece of advice, to be honest. So thank you again, Ekansh sir, for doing this.
Yeah, thank you, Ankush. As I said, thank you for having me on your podcast. I think you have been doing great, and it was actually quite good to interact with you through this platform.